Hey, what's up everybody? This is Edward, your favorite homeboy. Today I want to talk to you about the idea of being 100% diversified in your portfolio. The reason this is important is because if you're not really diversified and something comes and just smacks the stock market to smithereens and now you're like, you lost half your savings, you realize, wow, that didn't work out really well. But if you were diversified, you probably would have took a much less of an impact than if you were just solely focused on one thing. So if you want to know what it means to be truly diversified in your portfolio, watch this video, because if you're not 100% committed to the idea of diversification, or if you're not 100% committed to the idea of anything for that matter, it just looks silly. It's almost like being halfway committed to shaving your beard. So I have bad news and good news. The good news is that I grew this beard out when the shelter-in-place orders started coming around, and it was good practice to stay in your home because of the virus. So I was like, maybe I'll grow this out, and I'm pretty pleased with it. The bad news is the wifey doesn't like it, so it's got to go. But I couldn't resist the urge to use it as a metaphor to show you how silly it looks if you're only halfway committed to something, like halfway shaving your beard. I mean, you either like the scraggly look or you like the clean shaven look, but you can't have both. And so, that's better. Smooth like a baby's behind. Well, if you ask most investors, they'll tell you they're diversified. Yeah, I'm diversified. I got Amazon and Facebook, and I've even got some Ford Motor Company. And I've even got stuff in China. And yeah, international stocks, and maybe even some real estate stuff in a real estate investment trust. But you know what? All that is tied to the stock market. So if the stock market gets hit, everything gets hit. And you can even Google, like, what does it mean to be diversified? And most of the advice you're gonna get are from financial planners who make commissions off you being invested in the stock market. So they're not gonna tell you to invest in something that's not tied to the stock market where they can't get a commission. So they're gonna say, yeah, you wanna diversify into oil and gold and real estate and all these different things? Yeah, do it in the stock market. And it's just not the same thing, because when the stock market crashes, all of that crashes at the same time. So what I want to tell you is what the 5 major asset classes that I'm invested in and the percentages of where I'm at on each of those asset classes. Now that's going to differ for everybody, but I'll just kind of share with you where I'm at. But before I do that, if you could hit the subscribe button and hit the notifications bell to be notified of future content, that would really help this channel out a lot. So let's dive right into it. What are the 5 major asset classes that I'm invested in? Well, of course, the obvious thing is real estate. I love real estate and I'm an expert in real estate, so that's always going to be the foundation of my long-term portfolio, my investments for retirement. So I have 45% of my assets in real estate, and I'm really comfortable with that because, of course, I live and breathe real estate. So 45% might be high for most people, but for me, I'm really comfortable with 45%, even 50, even 60%, depending on how undervalued or overvalued is in relation to the rest of the assets in my portfolio. And even within real estate, you can be even further diversified. Like you can have long-term real estate, which is a long-term rental, which is probably what you want to start with. But then as you acquire more real estate, you might want to diversify into short-term rentals, or from residential going into commercial, or from having everything in one location to spreading out the location. So for example, I have residential, commercial, I have stuff in Texas, Pennsylvania, Virginia, and so I'm more insulated from, if a hurricane hits one state, then at least I have real estate in other states that aren't as affected. Even recently, there's real estate syndication and real estate private equity. And the difference between those two are real estate syndication is somebody saying, hey, look, I've got this project on 123 Main Street, and I want to get a bunch of investors together to invest in this project, one specific property. So I've done a little bit of real estate syndication, and then real estate private equity is when there's not a specific property identified, sort of like fundrise.com, not one property specific that is identified, yet you're pulling a lot of people's money together to basically, you're saying, hey, I trust in the history and the company and the prospectus, and this is how they're going to invest in multiple properties. And so that's a little different, where it's not as specific. So again, in the real estate realm, lots of different ways to invest. After real estate, which is 45%, precious metals. Okay, precious metals, I'm talking mostly gold and silver. So my target percentage and allocation for precious metals is 15%. So I want you to keep this in mind, that right now the ratio of gold and silver, 1 ounce of gold and silver to the S&P 500 is less than 1, meaning 1 ounce of gold only buys 0.6 shares of the S&P 500. When I say shares, I mean the price of the S&P 500, where it's at right now. And this is at one of the lowest levels in the past 50 years. And it would need to rise nearly 6 times just to match the peak back in 2011. So right now, gold is very undervalued if you look at what an ounce of gold can get relative to the S&P 500. So gold is very undervalued, and you would think, wow, stocks are undervalued, it just took a big hit, but gold is still undervalued more. And what's more undervalued than gold is silver. And so I've learned a lot about this. One great resource is goldsilver.com with Mike Maloney. Just watch his videos, read his stuff, and you'll learn a lot about why it's important to have gold and silver as a part of your portfolio. So my goal is to have about 15% and to have 2-to-1 silver to gold ratio, because I think silver is a better buy and more undervalued than gold. All right, that brings us to cash. That's the easy one. I think you should always have cash in your long-term, I don't have to touch money, because when things get cheap and things get hammered, you want to be able to buy into the market at those times. And you won't be able to do that if you don't have any ammunition to do that with. And so cash, I recommend to have about 10% of your long-term retirement portfolio in cash, that you can just buy into things when you need, when the opportunity's there. Next, of course, is the stock market. Stock market is the obvious one. I'd say most people have 90% of their retirement in the stock market. So my goal actually is just to have about 5%, because I don't have a lot of time to be learning about companies and price to earnings and their balance sheets, and I just don't have the time. I'm busy working on my own company than to learn about someone else's company. So when I invest in stocks, mostly I'm investing in hundreds of companies through an index fund or S&P 500 or the Dow or the NASDAQ. That way my risk is really spread out. Now, like all people, I do like to dabble in stocks and learn about some companies. So I do have very, very few, couple $1,000s where I'm able to just buy individual companies. And my goal for that is to eventually grow that, where I can now have individual companies and diversify that into multiple sectors. There's about 11 major sectors, but for example, the technology sector, utility sector, financial sector, healthcare sector, you don't want to have like all your stocks in Amazon, for example, or all in the technology sector, because if that sector gets hammered, you're gonna feel it more, all right? So other than stock market, the last one is about 30%. Can you guess what that is? Well, that's business. So I think it's really important that you build multiple streams of residual income, because when you're investing in a business, really what you're doing is you're investing in yourself. You're investing in your ability to create income, to create wealth, and make money. Most people who are working 9 to 5, they may say, well, I don't have a business. Well, find a business. Find something that you love to learn about and how you can generate revenue with it. My goal is to have 10 streams of residual income. And I'm not there yet, but I do have, one is my brokerage business. As a real estate broker, I make a little bit of money that way. Another one is residential sales. I used to support my family just doing buying and selling. And so right now it's a very, very small part of what I make, maybe 1 to 3 deals a year these days. But if I wanted to, if my property management business just poof, went away, I should be able to ramp up buying and selling and make money that way, because I have that skill. So brokerage, sales, property management business, of course, that's the bulk of it, my property management business. And one business I created to support my property management business is a maintenance division. So I make some money with our maintenance technicians. That's 4 streams of income. Some of you know that I have a farm. And it's funny because these days I'm reading Facebook and people are like, hey, we're short of eggs. We can't find eggs in this crisis. And we have eggs to sell them. And right now we're like out of eggs. We have 3 people that are committed to getting egg shares. But other than that, people who are buying eggs just kind of like onesie twosies, they're coming and they're buying eggs from us. And so we're like short on eggs. But if I wanted to, I could ramp up production. I can have an egg business. I can, we raise pigs on this property. I can sell pork if I wanted to. So farming, even though right now I'm losing money every year, it's fun, it's a write-off, and we're learning a new skill while we're at it. And of course, my most recent business is this YouTube channel. Right now, it's definitely in the negative, and it's gonna be negative until I hit maybe 100,000 subscribers, which may be a while or maybe never. But I'm having fun with this, I'm learning, and anything I do related to this channel, like when I buy whiskey and I do an interview with other people and we drink whiskey, that's a tax write-off. So find a business, find something you love, learn how to make money with it, and take advantage of all the tax advantages of having a business. So 30% is kind of where I'm at with that. The value of my business, which I'm being really conservative, is just kind of like half of my annual cash flow is the value I'm giving to my business, which is very conservative. So let's take an example of a typical $100,000 portfolio. If you had $100,000 and you're like most people, you probably have maybe $10,000 just sitting on the sidelines in cash. And I bet the $90,000, the rest of that $90,000 is in the stock market. So if the Dow, which recently took a 20% hit this year so far as of this video recording, 20% hit, if your $90,000 in the stock market took a 20% hit, you would lose $18,000, which is 18% of your net worth just gone in just a couple months of 2020. 18%, right? You're probably not getting a lot of sleep if you lost 1/5 of everything you've saved for. Now, if you just take the percentages that I presented to you that I'm doing personally, and again, your percentages will differ. And if you just take that, you'd have $45,000 in real estate, which is probably good enough for one long-term rental in most places. You can get a long-term rental for $45,000. Metals, precious metals, $15,000, good enough for an ounce or 2 of gold and several ounces of silver. And cash, $10,000 cash, that's easy. Stock market, you'd have about $5,000, and a business, $25,000, or just somewhere around that. Now, if $5,000 your stock market, your stock portfolio took a hit of 20%, you're talking just a $1,000 loss. $1,000 of $100,000 is just a 1% impact on your net worth. As you can see, it's way better than 18%. And that's a really simplified example, but just shows you the power of diversifying, true diversification of your portfolio. Well, I hope you enjoyed the content and learning what it really means to be 100% truly diversified, not have everything in the stock market. It's never too late. I reallocate my portfolio maybe at least once a year. So just take a look at the percentages and go slowly. And you don't have to buy like 10 homes tomorrow. You can start with the stock market, something easy. Gold and silver is pretty easy. Obviously, a business is going to be a little bit more difficult, real estate a little bit more difficult. And so you can kind of ease into that as your net worth grows. If you like this video, don't forget to subscribe and share this with your friends. Also, if you could hit the thumbs up button below to show us you like the video. Again, this is your favorite homeboy signing out.